Everyone wants to pay less taxes now, but what if it's the worst decision that you could make financially at the moment? Now, I know that's counterintuitive because, of course, a lot of people think that they should, save as much as possible, and rightfully so. Because once you make a decent amount of money, of course, you start to see how much of it goes to taxes. But one thing you have to consider is that sometimes we're driven by what I call the short-term savings illusion, which, yes, we're saving, at least for the moment we are, but the long-term effects are not quite so. And in considering your compensation plan and in considering saving taxes, it should not only be an at the moment consideration, it should be something you consider long term. And leaving income inside a corporation, because we talked about leaving income inside a corporation and the benefit of that, because you're in a lower tax bracket in many instances, may minimize taxes today, but in the future may lead to significant tax burden and may take away certain opportunities that you would have had in the future. So, for example, if you're a business owner, you're looking to sell your business in the future, one of the benefits that you have is that of lifetime capital gains exemption. And so in order to qualify for that, you have to be a qualified small business corporation, which requires you to have certain active business operations. But if you have left a lot of money in your business and a lot of investment built up, what will happen is this accumulating investment assets inside the corporation reduces the active business percentages, and potentially you could lose the lifetime capital gains exemption. So when you go to sell your business, the benefit that you would have normally have of having a significant lower capital gains payment because of the deduction, that's now taken away. The accumulation of investment assets in a corporation essentially may adversely affect the ability to claim the capital gains deduction when the shares are sold. So you really want to consider that yes, it's great to have retained earnings, but at what cost, right? Let's talk about a little bit more about investments inside your corporation. If you have investments in your corporation, one of the benefits is that it reduces taxes today, yes, because you're not pulling it out and it's left in a corporation at a lower tax rate. But, of course, like any investment, you might have some ups and downs. And also the benefit also for having investment is that you have the benefit of deductions and losses. And you may generate what's called a cumulative net investment loss. And if you have a cumulative net investment loss, that also prevents claiming capital gains exemption on a business sale. So you also want to consider that. So yes, you kept money in the corporation because what you wanted to do was to have return in the corporation versus pulling it out and paying higher taxes. But one of the disadvantages to that is that you could have a positive cumulative net investment loss balance, which prevents you from claiming capital gains deduction. And ultimately, that reduces your ability to shelter large amounts of gains from the sale of your business or a qualified property. So that's another thing to consider. And of course, I'm thinking about, folks selling their business here, but let's talk about situations where you're keeping the business. Again, you might defer taxation essentially by keeping these investments in your corporation at a lower tax rate. And leaving income in a corporation to avoid taxes today may be great at the moment, but if you're close to retirement, and especially for the next few years, your personal income will likely decline significantly if you're not actively in a business. And potentially your salary is going to be lower, you're in a lower tax bracket. But of course, you're probably used to a certain lifestyle and you want a certain amount of money. And you're going to look to the corporation, and now pulling from the corporation when you should be in a lower tax bracket may increase your tax bracket significantly, right? So over deferring income for immediate tax savings may actually cause you to pay more taxes overall when the funds are eventually withdrawn, because they're withdrawn at a higher tax bracket, right? So you really want to consider that. Let's stay with retirement for a little bit more. Tax reduction should never, by the way, override your overall wealth goals. And if you're purely driven from a tax perspective, what will often happen is that you're going to sacrifice liquidity, you're going to sacrifice flexibility, and quite frankly, you're probably going to sacrifice long-term family wealth, right? Because it's not only about you. Oftentimes, if you are transferring that asset to your family, or even just the amount of money that you're able to pull from the corporation to use for yourself and your family, that's going to be significantly affected. Because what may happen is, once you get to retirement, if you contribute to the RSPs, you contribute to CPPs, you're getting OAS, these are all going to be somewhat fixed income. All right, so CP is going to be a certain amount that comes to you. OAS is going to be a fixed amount that comes to you. If you have an RSP, by the time you reach 871, the year in which you reach 871, the end of that year, you have to convert it to a RIF, which also has a minimum amount that's coming out. And so you have this fixed amount that's coming out every single year. And we're not even talking about other potential pensions and strategies that you may have put in place to generate cash flow. That's just three basic ones. And having those cash flow coming in, that may not be enough to sustain you. And you may be used to a certain lifestyle. And so now you're looking to this corporation, and yeah, you're probably somewhat involved, so you could mix it with salary and dividends. But quite frankly, if you had pulled, for example, income from the corporation beforehand and built up, for example, TFSAs, or built up an insurance policy, which gives you the opportunity to buffer with cash value, or built up other non-registered funds, which may have the opportunity to, yes, pull money and pay taxes, but at a lower tax bracket, you would have probably been better off. And that's why when you talk about tax planning and tax minimization, it's not just about today, it's about the long term, which is why taxes cannot be looked at in just a vacuum. It has to be looked at your overall situation. And so when you're planning, you should not just be planning about, okay, just to save this, but you should step back and go, what are my goals? And beyond my goals, what you want to consider is, what are my family goals? What does spending the next 2 years, 3 years, 4 years look like? The next 10, 20 years? How will this affect my family? How involved will they be in the business or not involved in the business? How much money will they need? Maybe you are older, but you have a younger child who's probably now going through university. And so there are additional funds that's going to be needed to fund university. Or maybe it's your grandkids. These are all things that have to be considered versus, let me just leave all the money here and pay a lower tax bracket and enjoy the benefit of that. No, because it could ultimately cost you quite a bit in the long term. Hopefully this was helpful. If it was, like, share, subscribe, and I will show up again with more added advice for Canadian business owners. And I know I've been focusing on finances because I know taxes is a hot topic for business owners, but I'll talk about other topics in terms of growing your business and other topics which Canadian business owners deal with, because my goal is to make content that strengthens business owners in Canada so they could be world class. Take care until next time.